Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me is Rob Romano, our Director of Research. This is our second of three videos as we talk about the 2023 outlook for investors. So Rob, Eric and I previously talked about the impact of the Federal Reserve raising rates on fixed income and what that meant for that group of investors. How does the Federal Reserve raising rates now impact the equity markets both now and looking forward?
Sure. In 2022, the markets have been really focused on the Federal Reserve and commentary from Fed officials. And on this graph here, you can see that this has been one of the fastest Fed tightening cycles in modern history. The Fed has raised rates 7 times this year for a total of 4.25%. And what we do know is that when interest rates go up, asset prices tend to decline. If we look at one other Fed tightening cycle, that would be 2015 to 2018. The Fed was very gradual. They went about raising rates very methodical, a quarter point at each rate hike. This cycle's been much different. The Fed raised rates much faster, much farther, really than anyone expected. And not only are they raising rates, but they're letting their bond portfolio mature at $95 billion per month. So with that said, we do think the market's focus is going to move away from the Fed and that the market's going to be more focused on those hikes, but the impact of those rate hikes on the economy and more importantly, corporate earnings.
Yeah. Well, we always talk about, and you really talk about when we're talking about equity markets, the impact of the Federal Reserve and corporate earnings, because that's going to drive valuations in the market. So as we think about 2023 corporate earnings, what are we starting to see?
Yeah, to take a step back, in the third quarter, 69% of companies beat expectation. The one-year average was 78%. So that beat rate is declining. If we look at the revenue line, revenue was strong. It was up 10% year over year as companies had the ability to pass along those higher costs to consumers still. The earnings line, that's where we really saw the weakness. It was one of the weakest quarters that we've seen in some time. And the primary culprit was S&P 500 operating margins. At the end of 2021, those margins were at record levels, and now those margins have come down throughout the year, and we think that trend's going to continue into 2023. Also, energy was a big provider of that earnings growth for the third quarter. When we factor out energy or look at the S&P 500 earnings ex energy, they were down 5% year over year. So on this graph here, what we have here is the S&P 500 earnings estimates for 2023. So they started as high as $250 per share, and now they're down to around $230. So that's quite a decline. And if the economy continues to decelerate from here, or if we go into recession, which is possible, then it's likely those numbers are going lower.
Yeah. Which truly creates a challenge for valuations and index returns going forward. So Rob, even though markets are challenging, we know there's always opportunities or within groups of the equities. So what are we seeing as some opportunities for clients in 2023?
Sure. We think the opportunities are away from those very large cap companies that concentrate the S&P 500. And again, many of these companies are those large cap growth names. We know these names so well. It's the Tesla, the Amazon, the Apple, and the Microsoft. So collectively, you can see on this graph here, they're trading at roughly 24, 25 times earnings. So that's expensive by historical standards. So we think the opportunity is away from those and the more reasonable valuations in the remaining 490 of the S&P 500. And many of these asset classes would be your mid-cap names and even some of your smaller cap asset classes.
Right. In fact, we've already started to move portfolios over the last 4 or 5 months into a bit more of that mid-cap and even a little bit more in the small cap space. Rob, as always, thank you for sharing your thoughts on the markets. In the next week, you'll hear another video from myself and Pete Cahill as we talk about the emotional ride that was 2022 for investors. As always, thank you for the opportunity to serve you and your family, and have a great holiday season.